All right, what's going on, everybody? We are back and we are ready to watch this FOMC. Let me just pull it up here. I've been working like crazy today, and I was just like, you know what? We actually need to have this on, and we need to like show everybody what's going on. We got to be on top of this. So let's head over to this. Here we go. Here we go. Hold on 1 second. All right, hold on. Got to make sure that we got the here we go.
218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated.
Ooh, that's good.
FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat.
This guy's like watching paint.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026.
That's good for the crypto markets, everybody.
High inflation imposes
hella good for the
significant
crypto
hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however.
He needs to work on his posture for sure, man.
Inflation risks.
He sits behind a desk too long.
We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
That's good.
In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026.
All right, so there we go. They're talking about lowering the rate. All right, they're talking about lowering the rate now. That's really bullish. Watch your crypto bags. They may be going up. By the way, share this because I'm going to give you my perspective on this live. We're going to keep this going, but this is really, really, really good stuff right now.
But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
And the crypto
we at the
community.
Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings.
Which, by the way, if you're in the United States, I need for you to put in the chat, just because I don't live in the United States, but I'm interested in policy because it affects what I do in the crypto market. Can you type in, have you experienced over the last year, like prices still going up, or have things kind of like plateaued? Let me know. And if so, the things that are going up, what are the things that are going up? I want to hear from you because, just what this guy's saying, he's saying that it is going up, but let's see.
Last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick.
Guys, gals, smash that like. Do me a favor, smash that like real quick. We need to get more people coming over. Let's keep going.
Nick Temeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response, which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came. I think it happened a couple.
Okay, so just to give you guys a little sneak peek as to what's going on in the market while we're doing this, and we'll get back to that. Oh shoot! So I want to show you the Bitcoin chart. I'm on a really small time frame. I'm on the minute, which means that I am I'm looking at each one of these candles as a minute. Okay, and look at this. This thing just blasted down. And it actually started blasting down a few minutes ago. So this is what we want to look at, and on this, especially on this time frame, like how much has gone down. Like, so how much has it gone down? From the height of today all the way down to where we're at right now, 1.19%. And so not that bad. But if you would have shorted this on 10x leverage, you would have made a lot of money. So I almost degened and shorted it, but no, thank you. All right, let's get back to this. Let's see what else happened.
A few meetings ago. So when that happens, when there's an important data print during.
And by the way, I think the reason that the market is starting to dump, despite the fact that he did say that they're anticipating having lower interest rates here in, later this year, early next year, and then all the way through to 2026. I think people were expecting just a little bit more concrete, like well, like, is it going to be September? Is it going to be June? Usually they give like a clear cut explanation as to when they're going to do it. Right now, they're just basically targeting it and going, oh, well, hold on. If something breaks, then probably we'll start to lower it. But in the meantime, we want to kind of redline that. But we're anticipating cutting, so let's see what keeps happening.
Meeting first day or second day. What we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing, mostly now through the.
I wonder what kind of immigration channel they're talking about. And like this is super interesting. So like when I was in Dubai, one of the things that I actually liked about Dubai was that they had an immigration policy where they're like, look, anybody can come over here. You want to come from India? You want to come from, wherever. Philippines. There's a lot of people from India, Philippines. What's the country next to India? I'm blank. Pakistan. All right. You want to come from those places? Cool. We got you. You have 30 days to find a job. If you lose a job, you have another 30 days to find the job. And if not, you're out. All right. Where in the United States, it's really become a travesty. Before, you had some immigrants coming in and all that stuff, which, by the way, the reason the United States population keeps growing, the main reason is because of immigration. And if you don't believe me, look it up. All right, look it up. I might try to pull it up as we're talking here, or as we're hearing this. But the problem with that, okay, is that you're going to be having a whole bunch of people coming in and doing like the shitty jobs. It's going to drive wages down, but then the price of things keep going up. And so, in my opinion, the United States really should get innovative, which they're not going to, but they should be looking into a way that they can monitor this better. Okay, cool. Let's let some of these people in, right? Maybe not however many millions of people have come over the border in the last few months, but maybe, half of them or whatever, if there is a supply and demand. Okay. And that really should be the way that we do it, because look, here's the bottom line. There are jobs that people do not want to do as Americans. All right. And there are jobs that people will do for way, way, way cheaper. Okay. But this is something that I do think now they're talking about immigration channels. I mean, come on. What immigration channel? The illegal immigration channels? Because that's where the majority of people are coming in right now. And I don't know. This is something that I think, and listen, for 18 years, I worked with lots of Hispanics, mostly from Mexico, who came over here undocumented. Some of them got their documents. Some of them didn't. Some of them qualified for the Dreamers Act, all this stuff. I'm not opposed to that, all right? I'm not like, no, people shouldn't come here, right? But I am now getting opposed with the massive amounts of people coming in, all right? And I think personally, this is kind of like a Democrat thing where they're trying to gain more votes for them. So they're giving them more entitlements, basically paying them for votes, which is real shitty. All right. If you're going to bring people over, even if it's illegal, there better be like supply and demand, because if not, what's going to happen? You're just going to keep driving down the price that people get paid. And then with inflation going up, it's not going to help anything. Anyways, let's get back to this. By the way, if you like what I'm talking about here, hit that like button.
Immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit. And that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully. And that's what we see. We see gradual cooling, gradual moving toward.
Maybe while we're on here, maybe if one of you all can actually put, if you can find the statistic while we're doing this, but maybe you can put in the chat how much has the actual wage standard gone down? Because this is another thing that affects inflation, right? They're saying, well, if people are getting paid less, then technically the price of things will start to come down. Why? Because people can't spend as much. So what these companies will do is they'll start to lower their prices. And that's where we get a deflationary factor to get back to this like 2%. And by the way, I've been reading y'all's stuff here in the chats. Look at some of these comments here from some people. I'm like a little blown away, and this is scary. So it says here, let's see, somebody said that it was like, oh, look at this. Inflation 10 to 30% more where they're at. And I just asked for like this year, right? Most things are still up. Food, insurance, automotive sector. That's crazy. DTE has a budget-wise plan for electricity, but if you miss one payment, you get out of the plan. Somebody said here in Hawaii, food prices have rocketed, which, a lot of food comes from Hawaii. I've been to those pineapple farms. They're beautiful. And they got bananas. They have all that stuff. Like here where I live in Panama, pricing has remained stable. But then again, the inflation here, even during the pandemic, was less than 1%, but they don't have a Federal Reserve. They don't have a treasury where they're just printing unlimited amounts of money. So that's much different. And by the way, Panama is one of the few countries that does that. And I'm looking at the price of Bitcoin, and it's still going down. It's at 68,600. So it's down about $1,000, more than $1,000, about $1,300 just in the last few minutes. So let's keep going.
Better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
I
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, we're
So hold on. Okay. So he's saying basically, you know, the rate cuts are probably going to be coming 2025, 2026. Now here's my take on this. Okay. I actually think it's going to be sooner, but look, here's the bottom line. If they start to cut rates right now, remember, we got an election coming up in November. All right. If they start to cut rates right now, and you have to look at the tactical side of this, right? Then what happens if things start to become undone? Now, it's not going to happen immediately. It won't start to come undone immediately if they start to cut rates right now. But what they'll probably have is this surge in investment, in more speculative investments such as stocks, crypto, maybe even real estate. Real estate more on kind of a longer term pattern. But check this out. If they do that, and let's say they get more towards the end of the year, we have this massive pump and then this dump right before. People could be like, because people's memories are super short term. All right. So what happens is, in my opinion, what they'll probably do is closer to like September, October. That's when they're going to go, oh, check this out. And they may even freaking skew the data. I swear to God, this data is so skewed. And we're going to get into that here in a little bit. But they may even skew the data to where they're like, oh, look, inflation's down by like, you know, whatever, 0.5% or whatever, right? Something like that. And then they go, well, we can raise interest rates again. Now, will it sustain? Maybe. Who knows? I don't know. All right. But will something break? Who knows? There's a lot of things that are on the precipice of breaking. A lot of banks, like 160 banks that are doing this, that are on the teeter of snapping. I read the other day. So let's see. I actually think come September, October, they're probably going to do it. And guess what they're going to say? Look at how good the economy is, guys. Look, everything's pumping. Crypto. They're not going to start with crypto. Real estate, this, that. All of a sudden, people are buying real estate in droves again. People are spending money in the stock market. Oh, wow, things are great. Now they're going from bonds to all these speculative assets. People are starting to make a lot of money, all right? And then Donald Trump's not such a good guy anymore. And look, this is all because of Joe Biden. I really think that that's going to happen. But let me know what you think is going to happen on the chat in the chat.
Where the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up. but I want to remember to point out that long run neutral rate of interest is a long run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent, but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and you will see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. I mean, we're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Mike.
Michael McKee from Bloomberg Radio and Television.
So real quick, I see in the chat here, Animir says that that Costco doesn't have the food and lots of empty shelves where he or she lives. I'm sorry, Annie. I don't know if it's a he or a she. But is anybody else experiencing that? I mean, in your markets, are you experiencing fast food? I know here where I live in Panama, 85% of the food is sourced locally, especially the vegetables and the meat and all that stuff. And so all 85% of it is sourced locally. And that's one of the reasons why I actually moved here, because I started hearing about all of these potential food shortages in the world. And so, and we buy, almost all of our food. There's some things that are like luxuries. We have like our own type of, like a Whole Foods out here that has some products that are, shipped in that, they're luxury. It's a gluten-free noodle or something like that, right? That's not made here. But push comes to shove, like at least we have food, we have, stuff that is here fresh and a system set up. Is anybody else experiencing that? So, oh, hey, it's AC. What's up, AC? Let's see here. Natural grocers also empty. In Hawaii, 93% of our food is sent here by container. Why? Like, our farms aren't able to sustain the population. Oh, okay. Wow. If you're cut off, I mean, y'all better have fishing rods. Yeah, like Tanner's saying, grow your own food. I listen, I agree. Like, it's not, but here's the thing. All right. It's not plausible for everybody to just like, oh shit, okay, I'm going to like start growing my own food in my backyard. What if I don't have a backyard? What if I live in an apartment, right? So that's why you have to look at why it is, or what country that you want to live in, where the food is abundant and it grows like crazy and there's enough to support your population. Another country that I was there just 6 months ago was Uruguay. Has a lot of resources, a lot of food. Chile has a lot of food. A lot of oranges from this part of the world come from Chile. A lot of bananas. They can grow things over there. It's a very Mediterranean type climate. It's just, flipped around. So there's definitely an issue there. If you guys are starting to experience, empty shelves or empty, grocery produce bins, that's an issue. That's an issue. Again, I've been seeing this coming for a long time. I want good food. While, the food out here, they don't necessarily say it's organic. Like, it's probably more organic than the organic food in the United States. And it doesn't come here from other countries. So it's like, hey, look, you buy a banana here, it's going to spoil in like 3-4 days. You got to eat it. That's the way normal food works, right? But a lot of people don't understand that. Okay, a lot of people don't understand that, my banana shouldn't be good for 3 weeks. All right. Even my organic one, right? Just because it's organic doesn't mean that it's, that's the way it should be. So, I hear they spray a lot of things to like preserve them, to bring them from Ecuador, from Mexico, because that's a hike, guys and gals. That's a hike. So, yeah, let's see here. Pigs of the world as far as processed food. Yeah, you don't want to eat that processed food. You don't want to eat that processed. I mean, if you process your own food, that's cool, but you want to try to stay away from the Cheetos, the Cokes, the crap. Even some of these really good foods, they're supposedly, real organic and this and non-GMO, and they're so processed that it's like, eat them and you're just like, oh, gross. Like, they put it in these space bags, to maintain them. And I'm always like, yeah, no, thank you. I'd rather just, I'd rather eat less, to be quite honest, than eat like things out of a bag nowadays. And you can get creative with your stuff. It's just time. It's time consuming. All right. Now, you guys, I'm kind of getting bored with this. It's just kind of, these people are just asking more of the same. And these reporters, they're just trying to get some time to, like, put something in their newspaper and get some credibility. Would you guys mind if I shared with you? I'm going to share with you right now. All right. This, let me share this tab with you here. Okay. So this is something that I was watching earlier today, and I want you all to watch this because I think this has something so much to do. And I'm going to interject here on this, but this is an interview that Graham Stephan did with Michael Saylor just a couple days ago. Let's check this out. This was 10 days ago, but they just clicked
common and correct
on a clip. And I want you guys to watch this because, for those of you who don't know, Michael Saylor, he's a Bitcoin maxi. The thing that I like about Michael Saylor, I was getting very frustrated with him because he was like, ETH is a security. Everything besides Bitcoin is a security. And he's one of the largest holders of Bitcoin. And so it was really easy to see, like, dude, you're trying to pump your bags. All right. You're trying to pump your bags. Chill the F out. Come on. There are good use cases for other cryptocurrencies, especially Ethereum. Okay. And to be quite honest with you, like, Ethereum is way more used than Bitcoin is all day long. All right. All freaking day long. It is way more used. There are more developers on it. There is more use case on it than Bitcoin. Bitcoin, look, it's the world's crypto store of value, but Ethereum is the supercomputer that everything runs on, and everybody's building on it. All right. There is nobody building on another blockchain that even come close to Ethereum. I don't care if it's Solana, ADA, you name it. They are building on Ethereum. Okay. So just a couple weeks ago, when they launched the ETH ETF, or they not launched it, but they approved it, the SEC approved it, Michael Saylor, there's all this stuff on YouTube and on Twitter that showed Michael Saylor going, they'll never pass it. Ethereum is a security, a crypto security, along with Solana and all these things. And then all of a sudden they passed it. And he did an interview. I want to find the interview. I want to do a live like this with you guys and go through that interview. But essentially he was saying, like, look, this one caught me by surprise. And he came back very humbled, saying, like, look, ETH, it looks like ETH may have a use case. And this is the Bitcoin maxi. A Bitcoin maxi, for those of you who don't know, is like somebody who is just only about Bitcoin. Nothing else is allowed. Everything else is sacrilegious, which is complete BS. All right. So he's been coming out with better stuff, which I really like after that interview. And I'm starting to listen to him again because he's really smart. He's no dummy, but listen to this interview. All right. And I want to comment on this because I think all of you are going to find some benefit out of it.
Common perspective is to think that money is the currency that the government gives you, and that the economic policies of the government are for the good, are for your own good, and you'll benefit by complying with them or accepting them. And that most conventional economic principles and conventional economic education is useful, or that conventional economic figures are valid. Economics, as we enter the 21st century, really is a pseudoscience. And I would argue that before Bitcoin, all economics was an art. It was somewhere between art, pseudoscience, and religion and philosophy, and political science. And it wasn't a scientific discipline or an engineering discipline. I'm not even sure the economists would disagree over that, by the way.
Sorry, everybody. I was on mute here. So this is what Michael Saylor is basically saying here. Okay. He's saying, like, look, the modern day, the economics, I should say, not modern day because we're in modern day and we're starting to get into crypto, but basically economics is an art. It's not a science or applied by mathematics. I mean, there's some mathematics applied to it, but just like this meeting that we were just watching of the FOMC, all right? Look at these guys playing with the interest rates because, inflation went up too much or it came down too much or all this, the economy because of COVID, because of all these things, right? But here's the thing that you got to understand, okay? It's not based off mathematics. It's an art. Even investing, okay, is an art when you take a look at this. But crypto really, really solves this. And it started with Bitcoin, all right? It started with Bitcoin, where they're like, look, why is it that we've got to have this ever-inflating amount of money? And he's going to talk about this ever-inflating amount of money. Listen to this. Listen to where he goes with this, because this is like, I never thought about it like this. I never thought about it like this, where this is economics currently is an art. And if you agree with that, all right, if you agree with that, you got to type it in the chat. Let me know what you think.
So we lived in a world where human race never had perfected money. We never engineered money. And in the absence of perfected money, you can't have economics as an engineering discipline. And that means that all of the political policies and political economic wisdom generally is subject to debate, and there is no right and wrong. So people capriciously do what they want to do, and they generate facts and metrics to support whatever they want to do. It's kind of a religious pseudoscience, and it's not rigorous engineering. It's not anchored in mathematics, scientific discipline, and you can't characterize it as an engineering discipline. Now, let me go back to the question of what is money. Fundamentally, people think currency is money, but really the academic definition of what is money is medium of exchange, a unit of account, a store of value. What is it really? Well, money is just, the most tradable good, the most durable, tradable element or unit of something that we can trade for something else of value. So in the history of the world, you go back 10,000 years, people might have traded seashells, or they traded stone coins or polished glass beads, or they might have traded arrowheads. What is the universal commodity that we know people will accept? And we use it to create a market economy to solve the problem of coincidence of wants, right? Everybody produces something different. And you need to, and if you have stone axes and I have food, and I want the stone axe and you want the food, we trade for some ratio. But if everybody doesn't have exactly what everybody else needs, that barter economy breaks down. It gets too complicated. So we know that there have been sophisticated economies for 1 million years. You can find stone axe factories that go back 1 million years. The issue really is, how do you make those economies work? Through a process of trial and error, people eventually arrived at metals, copper coins, silver coins, then gold coins, and they worked with some kind of metallic unit of account and type of money. But even in modern era, you can see people use bales of tobacco as money in the colonies before the Revolutionary War. In prisons, people use cigarettes as money, and POWs use cigarettes as money. What's the problem? The problem is in the modern era, we use fiat currency as money for the most part. And is it a medium exchange? Sure it is. Is it a unit of account? Sometimes. Is the store of value? It's a store of value with a half-life of some amount. So what's the half-life of the money? How long does it take for the money to lose half its economic energy? Well, that's what we'll call the inflation rate.
Listen to this part.
But the problem is the actual monetary inflation rate isn't reported. Nobody tracks it. So if you actually have $1 million of capital and you invest it in the dollar and you hold it there for 100 years, the dollar supply increases 7% a year on average over 100 years, which means that your capital loses
7% per year. Remember that 7% per year that the dollar supply increases.
half its value every 10 years. And over the course of 100 years, you're cut in half 10 times, which means.
Okay, so hold on. Let's go back a little bit because I want to get this clip done right for y'all. All right, ready for this?
Half its value every 10 years. And over the course of 100 years, you're cut in half 10 times, which means that you start with $1 million and you end up losing 99.9% of the $1 million. It gets worse if it's in a weak currency like the peso.
99.9% it goes down. All right. 99.9% that it goes down. Watch this. Keep going.
In that case, you'd lose 99.9% of your capital in 20 years. So what is capital? Economic energy, purchasing power. Most of the time when people think about money, they think about currency, but currency is an awful way to store your economic energy. So you can't really hold money very long. And then when they think about the inflation rate, they always focus upon the CPI, Consumer Price Index. That's just it's just a manufactured synthetic metric. And what is it? The establishment would have you believe that CPI is the rate at which consumer prices increase, and that's what you ought to be concerned about. Neither of those statements are necessarily true. Those premises are wrong. It's not the rate at which consumer prices go up, and it's not the rate you should be concerned about. It's simply the rate at which a arbitrary basket of goods defined by an economist goes up in price in a certain place. So if I define a basket of goods in Kansas and I track the price of them, then I've got a CPI for people that live in Kansas that live solely on that basket of goods. But even that's not quite true, because once I define that methodology, there's something called hedonic adjustments, which means every year or every few years or every 10 years, I can just arbitrarily take things out of the basket. Late one economist took coffee out of the basket. But for example, if I define a market basket of goods and that includes one concert every 2 months for the average person, and concerts go from $10 to $500, I could just take the concert out of the basket and I could say, well, in the modern era, people can watch Taylor Swift on Netflix and that's free. So instead of giving you 6 concerts a year that cost $3,000 a year, that looks like inflation. I mean, how's the average person spend $3,000 a year on? It'd be more than that after you add the merch and whatever. Okay, $5,000 a year on concerts. It used to cost $100. Now it costs $5,000. That's inflation. But if I just rotate that into Netflix Taylor Swift concert, not only do I not notice that everything went up to $5,000 a year, I actually announce gleefully that cost went down to go to concerts now. So conventional wisdom is people accept the conventional definition of money. So
listen to that part that he just said right there. So this is why CPI is so screwed up. Okay, this is why CPI is so screwed up. And I'm going to show you the option here, actually, once he's done here, because I want everybody to see like why crypto is different, why we're like really kicking ass and taking names. Okay. But he says, look, they keep lying to us about how they measure inflation, right? They may take out like, oh shoot, concerts went up by 30 times or 40 times. Okay. So let's take that out because you can watch that on Netflix. But yet probably more people go to concerts now than ever because there's more people in the world. All right. And while, yeah, okay, more people can watch these concerts on Netflix, it doesn't stop that these people, these artists are filling stadiums full of people and selling out. So if that goes up, they're like, oh, well, let's take that out. Not enough. It's Netflix is way cheaper. And now they're not even saying, oh, well, with Netflix, it's way cheaper. They're actually subtracting that from CPI. So it's not giving you an accurate number. Okay. And that for me really is just like, are you for real? You know what I mean? Like, how is it that we can actually get a real measure on this? And my opinion, not my opinion, my fact is on the blockchain. Okay. On the blockchain. And sure, you can like maybe add or subtract things on a, on the level of like, let's say I have an application that's connected to certain things. And if I want to omit that, then I can. But the fact that it's on the blockchain, if we have something like that, you won't be able to admit it. You may be able to do it on the application side, but as a whole, you won't be able to omit it. And so we see things like on DeFi Llama and all that stuff. I'll show you what DeFi Llama here is in a little bit, that I'm able to see exactly how much money is in each protocol. That they can't lie about. Okay. I'm able to see exactly how many loans there is against that money in a protocol. I'm able to see how much money is trading in real time, not like 60 days later or 90 days later, based off of some auditing firm that maybe could have gotten it wrong. Remember the art, okay? That's just not viable when it comes to crypto and decentralization. All right, so let's keep going, and then I'm going to show you some stuff here.
Accept a certain asset as money that's not really money, and then they accept, conventional definitions of inflation as being relevant and proper, which is neither. And then that causes them to make a whole host of mistakes, like, I'm going to give you 4% interest in your bank account. The CPI is only 2%, or our target is 2%. If you're getting 4%, then you're staying ahead of inflation. Well, what if the real monetary expansion rate is 12% and I'm getting...
So listen to that. What if the real monetary inflation rate is actually 12%? You're getting 4%. How much are you getting screwed by? 8% per year. You're still losing value of your money. Okay, this is crazy. This is crazy. He's making really good
giving
points.
You 4% or 3% after tax. Well, you're actually losing 9% of your wealth every year.
All right, so let me share. Oh, whoops. Let me share this screen for you guys here, because I want you to take a look at some of the things that we're doing with stable coins, which, by the way, for those of you who don't know what stable coins are backed 1-to-1 by the United States dollar. Okay. Now, some of them have some creative things like this Athena thing, this Athena SUSDE, okay, has some more creative things, okay, built into it, which, according to what I've read, a lot of these guys have figured out after Terra Luna or UST, okay, which was United States Terra, okay, which was supposed to be backed by, or had enough assets in it in order to be backed by the dollar, but it ended up being centralized, and there was a lot of things that people were calling it out for a really long time, but a lot of people just didn't care because they were receiving a 25% interest rate on their dollars. And then what ended up happening, it crashed, the peg of it crashed. But there's been 2 cryptos on this list that have been around even back then, which is Frax, okay, which Frax is a stable coin that is literally pegged and verified on chain because they have to hold those reserves by USDC, and DAI, which is also pegged to the dollar and has to have their reserves verified on chain. Both of those are decentralized. SUSDE is a newer one where it's using like staked ETH returns to like basically give it a yield on an annual basis, and it's very, very complex. I don't understand all of it, but supposedly they have solved the issue of how they could basically create this, really good yield on stable coins using staked ETH. Okay. Now, what is going on here? You take a look at SFrax. Right now, it's paying out 16.4%, and this is on Dune. I'm going to actually gonna post this here for you guys in the comments, so you all have access to this if you want to save it. But these are really good rates of return. All right, 8.7%. I mean, you're still probably not keeping up with inflation at that rate based off of what you guys told me in the chat. 23%, that's keeping up with inflation and beating inflation. 16.4%, probably keeping up with it, keeping up and beating inflation. So these are the types of returns. Like, let's say, for instance, if you lived here in Panama, all right, you would clearly see, like, I've been here 2 years, things have not gone up in price. All right. Prices have remained like this. Gas is still exactly the same. It's $3 a gallon, basically. They do it by the liter out here, but $3 a gallon hasn't really gone up. It's just remained there. Inflation is really, really low. And the government here actually subsidizes some things to make sure that inflation keeps low. So that's a good thing. Okay. That's a good thing. Real estate, it drives me nuts. It doesn't go up. There's parts where it do. There's like little bubbles that, you know, you've got here. But for the most part, things have remained pretty level. They're increasing, but not by that much. Less than 1% again. And I believe it because I see it and I spend here and, you know, all these things. So when I see things like this, and this is in crypto, and I can verify it on the blockchain, this is what I really like. And by the way, guys, gals, if you want, I have here a 7-day free trial. You can check this out here on the screen, okay, down below. And we've got a really, really good course where we teach you decentralized finance. We've got a self-guided course. Our community is second to none. We're constantly showing you the best of the best. We break it down, even if you're a novice and you don't know anything about blockchain, to people who are super experienced. We've got something for everybody. Okay, we've got something for everybody here. So definitely click on that. It's 7 days free. And if you don't like it, you can always cancel. All right, you can always cancel. But we are on the bleeding edge. We have our own app on the Apple Store, on the Google Store, web-based app. It's really, really good. And we've got also something called the Managed Vault, where we can decentrally manage your money without you losing custody of it, which is awesome. It sits in your wallet. And if at any given point in time you want to take it out, you can. We cannot touch it except for moving it on the investment side. So that's our plug for the day. But this is what I'm talking about, that the blockchain and decentralization and DeFi is more mathematical. We're like, hey, look, we can actually do things here using math and science that's defying all the stuff that's going on in the in traditional finance, which is so lack of transparency. I just did a webinar with Billy Carson a few days ago. And, you know, I went into the lack of transparency in Wall Street. It's horrible. It's absolutely horrible. So I would, if I were you, and I'm not, I would be looking into how I can learn this stuff, because now I'm my own bank. I'm my own bank. All right. And I'm able to make decisions to where I can make lots of money doing what the banks do, but I'm using the technology to do that. And I'm using math to do that. And again, this is what we teach. So if you guys are interested, get down there. If you can do me a favor, if you've liked this live, smash that like button. If you haven't started following us, follow us, because we're going to keep bringing really good stuff like this. And I've got a whole bunch of really good content coming out in the next few days. So keep watching for that. And we're going to be live here. I think tomorrow we're going to be live. So show up again tomorrow. We'll see you. Thanks everybody for showing up. Hopefully you learned something. I know I did. All right. Cheers.